When people sign up for the alts.co newsletter, they're looking to read its deep dives into alternative investments like art, baseball cards, and rare books. But the most serious investors in its audience want access to actual deal flow. And to gain that access, they sign up for Altea, a high-priced membership community that actually vets potential deals and allows them to invest. Not only does Altea generate revenue through the annual membership, but it also charges for management fees and carried interest. In essence, alts.co is a media company that monetizes via an investment firm. In a recent interview, co-founder Stefan von Imhoff explained why his company settled on this model, how it sources deals, and why he eventually wants to stop selling sponsorships within the newsletter. Hello, I'm Simon Owens, and this is The Business of Content, the show about how publishers create, distribute, and monetize their digital content. If you want to listen to an audio version of this show, subscribe to The Business of Content wherever you get your podcasts. By the way, have you ever wondered how I monetize this show? It's entirely reliant on subscriptions to my Substack newsletter. When you subscribe, you're able to book a half-hour introductory phone call with me. You also receive subscriber-only interviews with some of the world's most successful media entrepreneurs. Support the work I do here by subscribing at simonowens.substack.com. That's simonowens.substack.com. Or just Google the words Simon Owens and newsletter. And finally, if you're on the lookout for interviews with the world's most successful media entrepreneurs about how they built their businesses, then this is the show for you. So take a few moments to hit the subscribe button down below. Okay, let's jump into the interview. Hey, Stefan, thanks for joining us.
Good to be here.
So we're here to talk about an investment membership community you run. I've actually had you on the podcast before, so if people want to know your entire origin story, they should definitely go back and listen to that entire thing. But I just want to get people just very quickly caught up to speed so they understand what your company is. You run a company. It's called the kind of parent company is called Altco. Is that correct?
Alts.co, yes.
Yeah, .co. And so its initial iteration was like a newsletter that you started on Substack in 2020 or something like that, right?
Yep.
Yeah. And then kind of the thesis of the newsletter, what it eventually grew it into is it was based on these things called alternative investments, things that aren't, part of they're not like stocks and bonds. They're like art and water rights and baseball cards and stuff like these like things that are hard, that aren't really well regulated. It's hard to figure out what the value is, and kind of like your niche, right, is that you're writing about these things where it's kind of hard to figure out what the true value of that is.
Exactly. The alternative, esoteric, kind of eclectic asset classes of the world. There's a whole bunch of them. They're all different, and we do the hard work of analyzing each one of these kind of new burgeoning markets.
Yeah, and then kind of your bread and butter of what, or at least what you found to eventually be your bread and butter, your most popular content is you're doing these like extremely long deep dives. So like you might say baseball cards, and it'll basically be several thousand words of everything everything somebody might need to know before they buy investment or baseball cards as an investment or something like that.
That's partially right. So deep dives are definitely our bread and butter. We don't mess around with short form kind of, like ChatGPT, crap, right? Like we go deep, and it's very authentic analysis of both markets and opportunities within those markets. So think of the former as, we might look at, the market for, to your point, water rights, or the market for tequila as an investment. But we take that a step further, and we do spend a lot of time on basically deal memos, on analyzing, an actual opportunity for investing in 80 barrels of tequila. It's basically a giant due diligence exercise, and we want to learn for ourselves if it's a good deal and take everyone along for the ride. And if it is a great deal, we invest together as a community, which we can get to later.
Yeah, but that's like more the membership side. Like I'm still just talking about like kind of like the free newsletter and the free content and stuff like that. That's mainly the deep dives. Is that correct?
Correct. Yeah.
Yeah.
Like even if you're not actually investing, it's good to learn, and that's what we bring you.
Yeah, and so you eventually teamed up with another Substack writer, and basically combined forces, and you moved off the Substack, and now I think the last time I talked to you, you were managing everything from through ConvertKit or something like that.
It's called Kit now.
Oh, really? I didn't know that.
Yeah, they
I didn't
rebranded. It
realize.
was the whole thing.
Yeah.
Yeah, no. So we did move off of Substack, and I stand by that decision for sure. We just needed much more flexibility with a platform because we're so much more than content. But I'm always proud of starting on Substack. I think they were a terrific platform and a way to get started, even if it wasn't right for us long term.
Yeah, and then the last time I talked to you, had 85,000 subscribers to your newsletter, and part of that is organic, but then also through acquiring other investment newsletters and stuff like that. Is it still around that ballpark? Have you grown significantly since then?
We've done a lot more acquisitions since then. We tend to acquire mainstream financial publications, right? So the total reach now is closer to 190,000 after some spring cleaning. And a lot of that has come through newsletter acquisitions, which is kind of a whole nother ball game, whole nother world. But that's basically one area of growth that we found that we can really use to supercharge growth.
Yeah, and we talked a lot about it, that your kind of acquisition strategy in the last interview. So people should, Google that and go back and watch that if they want. But and then your early monetization was mainly focused on these kind of sponsored deep dives. So like a company or something like that would pay you to like take your analytical skills and create this like organic content that was meant to be entertaining. Like I mean, even though you would disclose it was sponsored, like the goal was is that your community or your readership would get just as much value from that as a non-sponsored type of or piece of content, right? That was your
Yeah,
main monetization to start with.
that's right. I think what we did well was we really learned how to tread the line between deep dive content that is really valuable, but also to your point, entertaining. I might not use the word entertaining, more like engaging, right? Like it's not dry. It's not not to knock ChatGPT a second time, but like it's very human, right? And that I think makes a big difference.
This podcast is not super pro AI. I wouldn't say it's anti AI, but lots of skepticism is definitely welcome and warranted. And so that was kind of your initial thing, but then you did this like really innovative thing and zigged, where lots of media companies zagged. Is you launched your own investment fund. So basically, kind of the gist of it, the earliest iteration was, we have all this expertise in investing. You might not have as much expertise or the time to completely evaluate these different assets. So rather than you having to go figure this out, how about you invest in our fund, and then we'll pull that fund, and then we will make these choices about what we'll invest in. And then I'm guessing it had like a typical 2 and 20 type of payout for you, where you were getting 2% of the fund and then paying it and then taking 20% of the profits. Is that kind of a fair assessment of the initial, at least the initial version of the investment fund?
Pretty close, yeah. It's That's the idea. It's actually a 1 in 20 model, not two. But otherwise, that's the idea. Is that look, we explore all these markets, we explore opportunities within these markets, and when we find something good, again, we're doing this for ourselves to understand what the good opportunities are. When we find something good, we deploy capital into that asset or opportunity, and that was the idea of the original fund, the Alts One fund. Correct.
Yeah, and fortunately or unfortunately, depending on what your philosophy on this is that, and depending on what country you live in, you have to be an accredited investor in order to invest in these funds. So it's not like you just opened the fund gate and it was like a Kickstarter. Only like a small percentage of your audience both had the net worth, like had the actual like funds that they could to give to you, but then also were actually accredited investors, right?
Correct. The whole idea of accreditation is a topic for another day. Suffice to say that it's a big point of contention in the alternative investing world specifically. We basically made a decision that we are absolutely optimizing our company around accredited deals and private opportunities that require accreditation. Yeah, so we do still work with what are known as Reg A type offerings, or Reg CF, basically crowdfunding opportunities where anyone can invest. But that is not the majority of what we do. The majority of what we do is for accredited investors. Correct.
Yeah, and that's probably because you're a small company and you don't feel like putting a huge legal firm on retainer or something like that, in case like you're just kind of trying to avoid as much legal headaches as possible or anything.
We're trying to avoid not as much legal headache, so that's always a pressing concern. It's more actually about the economics of non accredited deals. They're not great. There's a lot of overhead and bureaucracy and paperwork, and this is why you've seen a lot of Reg A companies fail or they're not doing well. So yeah, like we kind of saw the writing on the wall early and got out of that game, and now we're absolutely squarely focused on accredited investors with our community.
Yeah, and is that? I mean, I don't know much about the investing world, but like the stuff that doesn't require the accreditation, it's probably lots of just bad investments that are coming in and just dumb money and stuff like that. So it's hard to have an edge.
I
Or
would not use that terminology. I would say that with non-accredited opportunities, it's not that there's more junk. It's that the economics are so tricky that it's really tough to make the numbers work to make a compelling deal for the investors and for the company, the sponsor. With private placements, with Reg D placements, you don't have that problem.
and it was like it was, I don't know if it still is, but it was like a rolling fund where people could come. It wasn't like you had to raise all your money and then have a close off date. Like people could continually join the fund.
And that's exactly right. And they still can. And it's updated. Then basically the NAV, the entry price point, is updated quarterly. So that's exactly right.
Yeah, and then have you ever disclosed on how big that fund was or anything like that?
We haven't, but I'm happy to. It's about 2 million US.
Two
Yep.
million US. Okay, so that was kind of everything up until the last time we talked. Since we last talked, you have launched a membership community that seems to be still tied to your investing in the fund and stuff like that, but is also doing some other interesting things like live get-togethers in like faraway locales and cities, and like peer-reviewed vetting of deals and stuff like that. So how walk me through the genesis of like when how did you and your co-founder or whomever start discussing it? What was kind of like the build up to launching this new product, this new membership community?
It's a great story. So like I mentioned, we made the decision internally to kind of get away from the non-accredited deal flow and focus on the private placements, the accredited deal flow. And since we were doing that, we realized that what accredited investors are really looking for is vetted deal flow and kind of peer reviewed, community driven discussion around private placement opportunities. So we decided to kind of run with that. And we had experimented with some communities before. Our first community was kind of on Discord, which I absolutely hated. I couldn't stand the UX. I couldn't stand the just the you didn't have a lot of control over quality of members, and there was a lot of weird stuff going on.
It's also just such a messy,
Oh,
like that whole stream. Like it's just like it's also why I don't really like Slack that much. But yeah, I just don't think it's a great unless you're like really paying attention like 24/7. It's not a great way to like kind of find conversations you're looking for and stuff like that.
no, and it's also like with a lot of yeah, I mean, you nailed it. I don't want to spend too much time trashing Discord. It'll just suffice to say it wasn't right for us. We landed on Circle, which is we feel pretty good software to support our goals. But it's less about the software. I mean, we're still fundamentally an email based community, and that's really what we're cultivating here. So the idea is that look, there's a million real estate syndicates out there, right, where people share deals on multifam in Austin or hotels in California. And Lord knows there's a million startup investing syndicates out there running on AngelList and all sorts of places, right? Like, where do you go if you want vetted quality deal flow to buy 80 barrels of tequila or priceless artwork or rare whiskey or music rights? There's nothing out there. And that's when we realized, like, we are going to create that syndicate. Basically, we're going to create an investing community for a serious accredited investors who are interested in serious, terrific alternative investment opportunities. And that's where it began. So we started this in February of this year, 2024. And we kind of kicked things off with an extra special idea, which is that part of this due diligence. We talk about this idea of due diligence and vetting deals and how important that is. Part of this is actually going to the deal and seeing the deal live and meeting the deal maker in person. And that's exactly what we did with our first deal in the community, which was for 80 barrels of tequila. So we actually took a group investor field trip, essentially, where we took 15 folks from the community down to the city of Tequila in Mexico, where it's all made. And this was a due diligence investing trip where we met our dealer in person. We touched the barrels we were about to buy. We went backstage at the distilleries. We met the mayor. Really, immersed ourselves in the ecosystem, and that's what you have to do if you're going to get into alternative investing, right? I mean, there's no shortcuts to the due diligence. You just got to go and actually do the hard work. But instead of making it hard work, we decided to make it, something, that's kind of baked into the community to begin with. So that first trip was a huge success. Like I said, we took 15 folks down. We learned about not just tequila investing, but investing in Mexico more broadly, infrastructure, startups. There's a fantastic startup scene down there. Real estate. Everyone thinks of like real estate, places like Cancun, Puerto Vallarta. And we returned from the trip with a concrete diligence deal on 80 barrels of tequila, which we were able to raise $400,000 US with the community. And we invested in those barrels, and they're sitting in a warehouse in Tequila that we've been to, ready to sell in about 2.5 years from now. So that first trip was kind of the archetype of the type of real hands-on due diligence that we want to do with the community, and it was a perfect proof of concept. And now we're doing that like crazy.
So let me just walk through the logistics here. So you launched this community earlier this year. What's the name of the community?
The name of the community is Altea. It's Altea, and it's a subscription-based community. So members pay an annual fee, and not a small one either, to get access to the community, to get exclusive access to the deals, and to network and to go on these trips.
So was the fund you were running, did that get rolled into this, or is that something that's still completely different, or did that get wound down? Like what was happening with this fund that you were already running?
The Alts One Fund is absolutely still around. Our strategy changed though. See, instead of what we learned was this: instead of putting all the assets into a single fund, we realized it's actually better to have specific funds for each new deal, right? So, like, we could have added the 80 barrels of tequila to the Alts One Fund, but instead we thought it would be better to just create an individual vehicle for that deal, and for each artwork deal we get, and for the music rights deal we're spinning up, in the film financing deal. So every single deal that we bring to the community is actually its own fund. It's actually its own LLC. There's a lot of paperwork behind this. There's a lot of cost behind it to spin up an SPV for each deal, but that's the way to do it. That's what people really want. And that way it's a much more simpler kind of like value prop, like, because when you have a massive fund, people may agree with some of the stuff in the fund, they may not agree with other stuff, and they're kind of trusting you as the GP to make those decisions. But it's just a better kind of experience to say, like, hey, like, we've got a film financing deal here, we've got a music investing deal here, like, thumbs up, thumbs down, you're in, you're out. Like, give them the choice to invest in each deal, and we've had a lot of success with that. So that's our model going forward.
And is it still a 1 in 20 kind of structure, or is it like you're now monetizing through the membership fee and you're just presenting these deals and saying if you want to invest in it, you can, but the value or the way that we're monetizing is we're just like charging a membership fee so you can just get access to these deals? Like, what's kind of the structure there?
It's this is the thing about this world. It's such an unstructured world by default that every deal is different. And so we sometimes there's management fees, sometimes there's carry, sometimes there's one of those two, sometimes there's neither. So we on each deal, like, we work really closely with the deal sponsor. This is not a one size fits all situation at all. deals go through a rigorous vetting process before we bring them to the Altea community. And a big part of that is understanding the fee structure. We need to offer our members something that they can't get on their own, both in terms of like take the tequila, for example. Like if you want to invest in tequila, terrific alternative asset, by the way. But if you want to invest in it, like what do you do? Like where do you go, right? You can't go to tequilabarrels.com. Like there's no market for this. We make those markets. We're basically creating those markets, working with the deal sponsors and diligencing the hell out of them. So each deal is wildly different, and there is definitely no one size fits all. Typically, most deals kind of tend to follow the same structure where there's management fees and there's carried interest component, but it just depends on each deal.
And how are you sourcing these deals?
They're coming to us at this point, man. We actually have more alternative, unique, eclectic deal flow than we know what to do with.
So like
And
somebody who owns or is distilling that tequila or whatever the terminology is like aware of you and is like,
yeah,
hey, I want to present this deal to your investors or something like
that's
that.
it. I mean, we've been doing this long enough now that, like, we're just becoming known as like the go-to place. If you've got an alternative deal, like, talk to alts.co, right? Like, cause like they can help you out. And it's like, that's exactly what we want. Right. So we do some outbound, but man, no, it's mostly inbound at this point.
Hi there, Simon here. So that's the end of the free preview for this episode. If you want to listen to or watch the full episode, you have to become a paid subscriber to my Substack. When you subscribe, you get an automated email that allows you to book a half-hour introductory phone call with me. Subscribers also get the full-length interviews with some of the world's most successful media entrepreneurs. You can watch the video version, read the transcript, or upload the audio feed to your favorite podcast player. To subscribe, go to simonowens.substack.com. That's simonowens.substack.com, or just Google the words Simon Owens and newsletter.